Let's kick it off with what we've just seen out of China. First and foremost, signs of economic stabilization here. That trio of economic data looking good and has been looking better over the past couple of months. So walk me through it. What are we likely to see from China as a result? And is this the stabilization sign that investors need to dive back into Chinese equities?
Yeah, I mean, what you're seeing here is the cumulative impact of all the monetary and fiscal policy that came through 2023, just starting to give a little bit of support to the Chinese economy for 2024. And those numbers that we got earlier on today, they really do suggest that we're seeing some progress towards stabilization in growth, not necessarily a big re-acceleration, but a better likelihood that we achieve the 5% growth target. And when you take a look at Chinese equities that look so low value relative to the rest of the world, then that relative valuation is starting to drag capital back into China. It's making a compelling case, and we could see that persist a little bit in the near term.
Of course, this week we are going to see a number of major central bank decisions, of course, all capped together by the Fed. We've seen a second week of losses for US stocks, traders trimming their bets on rate cut expectations here. So what will we see from the Fed this week, and what should we be looking out for ultimately when it comes to the trajectory of rates in the United States?
I mean, I think it's very clear that the Fed's not going to make any change to their policy this week, but there is a really strong risk that we see those dot plots reassessed, and the number of rate cuts this year move from 3 to 2. And that's going to be, if that comes through, that will be a shock to the market, I think. We see that the market's currently pricing 3 cuts this year. The real challenge is the Fed may be able to impose its hope for just 3 rate cuts or 2 rate cuts on the market for the first half of this year. The real risk is if the economy continues to slow, and we're seeing that slowing taking place, with the unemployment rate moving higher, with the manufacturing PMIs remaining in below trend growth area, with GDP growth slowing and inflation slowing. This means that, from 3 rate cuts being priced in, there's still a real risk that the Fed is forced to cut more aggressively at the end of this year, reflecting weaker growth. And I think that will be a challenge for equity market valuations where they sit now.
Okay, fascinating. So just with regards to the strategy, you say don't chase equities in this environment given the uncertainty around the Fed. Bonds are the better play. Can you expand on that?
Yeah, I think when you look at the valuations in equities at the moment, it's not pricing in just a soft landing. The valuations are pricing in a re-acceleration of growth, a really perfect outcome where rates come down just so, growth picks up, inflation gets back towards target, and the Fed manages to do all of that with rates coming off just a little bit. That, I think, will be a challenge to achieve. Instead, over the last couple of weeks, we've seen Treasury yields bump back up to levels that look pretty attractive from an income perspective. And if we get 3 rate cuts, if we get 4 or 5 rate cuts this year, you're going to get some really good opportunities to lock away some capital gains in that Treasury space. So we think don't chase equity returns at the moment. Look to build some resilience in your portfolio and move back into Treasuries to lock away those higher yields.
Okay, fascinating. Isaac, just before I let you go, the other big wild card this week is whether or not we're going to see the BOJ stepping away from ultra easy monetary policy. Is this week too soon?
I think that we might see a hike there, but the problem for the Bank of Japan is that they're going to get a chance to hike once. I don't think they'll get a lot more hikes in. They're going to have a very difficult time to move away from negative or low interest rates because the growth is just not there. There's a lot of downside risk globally, so they'll take this opportunity, but they're going to find it difficult to deliver further rate hikes over the next 6 to 12 months.